Greetings, everybody. My name is Kevin Matthews, and I am the professor for Accounting 351, as we talked about in the previous video. So I'm going to go through the Chapter 11 problems and kind of talk a little bit about talk more about some of my personal beliefs or personal input into the answers. So, and it talks about the difference between, the first question I assigned was explain the difference between ordinary capital and 1231 assets. So an ordinary asset is, anything that is, when I think of ordinary assets, I know there's like a book definition, but where I think of ordinary assets, very commonly, I like to use examples. That's accounts receivable and inventory. And the reason why Congress set these as sort of the ordinary taxable assets is because they give rise to ordinary income. And so if you, for example, if you have some inventory, you manufacture, say, toys, and you manufacture those toys and you sell them to children and collect the money from the parents, you are making ordinary income off of that. And so what the IRS is not going to allow you to do, or Congress is not going to allow you to do, is to convert that inventory into a capital asset and receive preferential capital rates. And if you think about it, it actually makes sense. And quite frankly, I think there's a couple reasons why you wouldn't want to have it that way. Say, for example, instead of toys, you're manufacturing cupcakes, and your cupcakes get ruined. It would be very horrible for those assets to be capital assets, because then you only get to write them off and take $3,000 a year if you're an individual or owner of a pass-through. Capital assets are held for investment with an expected depreciation, or our personal assets, taxpayers' personal belongings. That's kind of the book definition. Essentially, Congress wants to encourage investments, and as a result of which they give you preferential gains treatments when you hold those investments. And so, a very common one, of course, is stock. But there's other things. It could be gold. It could be, jewelry. It could be other things. Now, a very good example of where like I said, I use the example of jewelry. Jewelry is one of those areas or one of those things that, you might sit there and think, a very good example is a wedding ring. I did not buy my wedding ring for my wife as an investment. That would be extremely impersonal, and quite frankly, I wouldn't find it funny at all. But technically, if you sell it, it is a capital asset, and that's kind of where they get into, taxpayers' personal belongings or personal use assets. Obviously there's, it does have value. It might go up in value. Actually, it probably did go up in value because we bought it when gold was next to nothing. And, but of course, it's got more sentimental value than the gold is worth. So, that would definitely fall into the capital assets. And 1231 are used for business, trade, or the production of income. And when we say business or trade, what we're talking about is that somebody's going out and starting a business, and you want to use that business as their primary source of income. The production of income is sort of it's usually what falls into production of income is your rental properties, royalties, basically things that earn money simply from your ownership of them. Now, of course, if you rent property out and you actively manage that property, there's, if you're a real estate professional, there's certain exceptions that you can get for that. And then if you have, or if, if you actively manage it or materially manage it, there's some additional tax benefits you can get as a result of it. We won't go into those right now, but those are sort of, it's seen as you are receiving money from the ownership of that asset, and as a result of which it is considered production of income. My favorite thing I like to do, I like to put things into codes. And I like to use, Code 162, because that's where they talk a lot about a lot of the expenses. And then, of course, production of income, which is more 212, Code Section 212. Gains on personal use property or capital gains, well, losses are non-deductible. They made that mention, and that's very important to realize. Okay, so the next question that we're going to end up doing is compare and contrast 1245 depreciation recapture and 1250 depreciation recapture. The 1245 recapture really talks about, here's the thing. Like I said, the paragraph's like this long. What I would really say is that 1245 applies to tangible personal property, and 1250 applies to real property. Real property, when I say real property, I don't mean real property as opposed to fake property. I mean real property meaning, property that is as real estate, commercial buildings, residential real estate, land, something that, if you ever take the business, of course, a lot of times it's done by contract. So that's all real property. And the 1245, the reason why Congress kind of put it in, if they think of income as sort of the balance sheet. And I always talk about how the IRS kind of thinks of the balance sheet. And on one half of the balance sheet, if I give somebody a deduction over here, somebody has to pick up income over here. A very good example, if I give an expense for, a service that's provided, for, very good example, as an accountant, you'll become a member of the AICPA. Actually, the AICPA is a bad example because they're a nonprofit organization. So basically, actually, I pay for my software. Very good example. So if they're going to give me a deduction for the cost of my software, they're going to go to my software provider, Thomson Reuters, and they're going to say, you've got to recognize income on that. And so that's kind of what they're looking for. Now, when they give you depreciation, it's an ordinary deduction on this side. So that income has to be realized and recognized on this side by somebody else. And one of the concerns that they were having was that if you fully depreciate your assets, you're getting ordinary deductions, and when you sell it, you're kind of converting those ordinary deductions into capital gains when you are picking up that income. And it's kind of violating that balance sheet principle. So what they're going to do is they're going to say, look, if you depreciate an asset and you sell it for, say, a $15,000 gain, you have a $10,000 depreciation, accumulated life depreciation. We're going to ask you to recapture that $10,000 as ordinary income because we gave you an ordinary income deduction over here before we're going to let you take capital gain treatment for the rest of the gain. And it would be capital gain treatment because of Section 1231, which basically says that we're allowed to take ordinary deductions. 1231 allows us to take ordinary deductions when it's a loss and capital gains when it's a gain. So then when we're talking about 1250 recapture, it is relatively rare. We don't see it much anymore because it's for property that was placed into service before 1987. Now, you may see this. I've worked where we've had buildings that were sold that were put into service. I think with this one client it was 1982, so it had 5 years of this expense, and the reason why is because they allowed an accelerated form of depreciation for land, but for the buildings that were placed into service before 87. It basically says that what ends up happening is you have to recapture the delta between what straight line is and what the accelerated depreciation is as ordinary income. And so that ends up happening. Now, don't confuse, and I've done this a couple times, 1250 depreciation recapture with 1250 unrecaptured depreciation. And that's basically where they say, hey, look, 1250 unrecaptured depreciation is where we have, it's kind of the same as 1245, but instead of recapturing it at ordinary rates, we're recapturing it at a flat rate of 25% up until the amount of depreciation has been recaptured, and then everything above that is 1231. Okay. And then we're going to get into sort of the big problem. I went ahead and and forgive me guys on this one. We went over these when we had our meeting on last week, and one of the things that I kind of began to notice was some of the ways that they had brought some of this stuff up. I'm not as happy as I originally was with it, but I'm going to go over sort of the big picture items. I'm not going to talk about the forms. We'll talk about the forms in another video, and so you will see that that later on. So they talk about here, war, we are rich, has been in business since 1985. And essentially what ends up happening is they give you this long story about how the accountant gets fired because he beats the client in golf for the first time ever. I would like to ask you how to handle separately stated items for tax purposes, and then also, help them to, so there's he has taxable income of $480 before considering the following elements, and then there's various elements that they kind of put into this. War purchased a plot of land with $100,000 with the intention of creating a driving range. Didn't happen. They went ahead and they sold it for $40,000. So what ends up happening in that case, and that is going to end up being it's going to be a loss. It's going to be a short-term capital loss taxed at ordinary rates. And what really drives me crazy here is that they'll say, in the answer of this, which I disagreed with, they said it was actually an ordinary loss, which is not true because it is a short-term capital loss at ordinary rates. So if your income, if you're going to be taxed at it as a gain, you would end up paying a gain on it. Okay, War sold its golf testing machine, Iron Brian, and replaced it with a new machine, Iron Tiger. It's purchased and installed for a total cost of $22,000 at the time of sale. Iron Brian had an adjusted basis of $4,000. Iron Brian was sold for $25,000. What's going to end up happening here is they had the original cost of $22,000, tax basis now at $4,000, so the difference between those two is $18,000. Iron Brian is going to be what kind of capital asset? $1,245. So you're going to have to recapture the $18,000 at ordinary rates, and then the rest of the gain, which is going to be $3,000, will be captured as 1231 income, because it's and we're making the assumption that it's been owned. Well, actually, it's not just the assumption. There's actually somewhere in this problem they've actually put the dates of it, and it is long term. So that's why it will qualify for 1231 treatment, because it is in a business and it is owned for longer than 1 year and one day. In the months October through December 2018, sold various assets to come up with the funds necessary to invest in their latest and greatest invention, the 3-dimple golf ball. Okay, so they give you the data below. And so what ends up happening is they're going to ask you to calculate gains on them. Probably the big thing to really, think about here, they had marketable securities, well, actually, let's talk about this. So Sunday's black leather sofa used in office. It was bought, 4/4/17, sold 10/16/18. So it's long term. Initial basis was $3,000, accumulated depreciation was $540, and then the selling price is $2,900. So that would actually be a gain of $440, and that's going to be all ordinary rates. Somebody's office chair, bought 3 of 16, sold 11 of 18. Initial basis is $8,000, accumulated depreciation of $3,000. Or I'm sorry, initial basis of $8,000. The accumulated depreciation of $3,000, selling price of $4,000. So the actual basis, the adjusted basis, is $5,000. They sold it for $4,000, so it's actually going to be a capital loss, or it's going to be a 1231 loss, which will actually be deductible as ordinary losses. Marketable securities, they bought for $12,000, sold for $20,000. They're long term, so it's going to be long-term capital gains. Land held for investment. Bought 7 of 17, sold 11 of 18. So it's, was sold for a gain. It'll be a capital gain at $3,000. Other investment property, they bought it 11/16 and sold it 10/18. They bought it for 10, sold it for 8. So that's essentially going to be a capital loss. And some people might say, well, wouldn't that be 1231? I would say that the answer is no. And the reason is that it is not used for the trade or business, and it is not for the production of income. Production of income is where you're going to actually generate something off of it. Now, if they had the investment property and they said, look, it's forest land, and we rent it out to people to go ahead and use it and shoot deer, different story. But this is actually held for investment, so that's why it's going to end up being capital gains and capital losses on that. Finally, May 2018, decided to sell the building where they tested their plutonium shaft, light gates, head drivers. Wow, plutonium shaft? That's got to be some pretty interesting stuff. I'm hoping it's depleted plutonium, but anyways, I'm pretty sure it is because they kill all their customers. So they purchased the building for $190,000, $170 for building, $20 for land. Time of sale, the accumulated depreciation was $50. Sold the building for $300,000. So the actual gain off of the whole thing, and essentially what's going to happen is you're going to have to apportion the two between the land and the building, and they've kind of given you this number where they said fair market value of the land at the time was $45,000. And so what they're going to do here is they're going to say, look, of that $300,000, $45,000 was sent to that. So you're going to use 45 minus 20, which is going to give you $25,000 for the capital gain of the land, for the 1231 capital gain of the land. And then, the rest of it, which is 300,000 minus 45, so it'd be 255 minus the 170 minus 50, so minus 120, so 255 minus 120, you're looking at about 135 of capital gains, of which 50,000 of it is going to be 1250 unrecaptured, which would be at 25%, and then the rest of it will end up being then the rest of it will end up being 1231. So I've kind of gone over those major items, so I mean, everything that I've said, let me just check. Yep, everything I said was answered in the book, except for the one or two areas that I noticed that they seem to have it incorrect. They want you to calculate the taxable income. I'm not going to go over that because it's not a whole lot. Like I said, we're going to talk a little bit about forms in a different video, and I'll try to get that put together here very shortly. And I know that'll actually be helpful when we review the test. Yes. Okay. So that kind of wraps it up for me. So here's the thing. If you have any comments, go ahead and put it in the box below. And I'll be very happy to hear from you about that. And if you have any questions, feel free to reach out to me. If you're my students, you know how to reach out to me. Reach out to me at my business email address. And if you are not a student, put your comments in the box below. I'll get back to you and I can answer any questions that you might have. Thank you very much.